Today, Carl is joined by Bryan Potts, who is an assistant vice president and senior strategist on the client solutions team within the investment solutions group at MFS Investment Management, where he supports multi-asset allocation initiatives and contributes to firm-wide thought leadership alongside MFS's chief economist. Bryan brings a practical, research-driven perspective to today's discussion, and we're excited to have him with us. So thank you for joining us, Bryan.
Yeah, no, I appreciate the invitation. Happy to share some thoughts and learn, and we'll just talk about what's on the minds of investors today.
Wonderful. Appreciate that, Brian. I know you had some slides that you wanted to go through, maybe do some initial thoughts, and then on from there, maybe I can kick off some questions. I think, broadly, everyone's talking about Greenland and, what's going to happen there, Europe, World War III, and inflation, and a number of hot topics. But I'll let you maybe kick off some initial thoughts on your end, and then we can take from there.
Okay, sounds good. I'm going to try to share my screen and bring these up. I'll try to put this in slideshow view here. Okay. All right. So, Carl, how does that look? Can you see the slides and still see me in a
Yep.
small window? Okay, perfect.
Yeah.
Yeah, so just to kick off a little bit of background about me, thank you, Mary, for covering that. I was one of those kids in high school who, I distinctly remember it sophomore year taking trigonometry, and I guess it was geometry, then trigonometry, and I was struggling. And thankfully, I had a teacher, Mr. Frost, that stayed after with me. And I think if I hadn't had that, I wouldn't have taken the path, that I took in life, which was typical undergrad finance. I went to Boston College for finance and did the CFA. And I love this industry. I would say most of the work that I've done has been on the manager research side before I joined MFS in 2014. And in this thought leadership role, it's been mostly strategic asset allocation. So I'm involved in the long-term capital market expectation process here. So thinking about forecasting return and volatility for probably about 20, 25, 30 asset classes in six different currencies. And it's really led to a great opportunity to work with institutions all around the world. Think about complex issues like currency hedging and, using risk models and things like that. The other part of what I do is this here today. Let's try to talk about what's happening in the markets, working on
Mhm.
rapid response like the Russell reconstitution last year. And so I really want to hear, I'll go through some thoughts. I don't have any crystal ball, but I'll give some thoughts and kind of frame up at least what we're seeing at MFS and try to tie it to some of the other work that's happening around the firm.
Yeah, it'd be wonderful.
So, just thinking about where we are with monetary policy. So this is Fed funds rate, looking at all the hikes, through start, 2020, 2022, and those three cuts that are shaded at the end of 2024. The first thing I believe is that monetary policy and cuts in interest rates, actually either direction, operate on a lag, and it's about 12 months. And so I do think that this is a tailwind. I think that those rate cuts are slowly starting to hit the market. We've had another three, and there's, I think, two cuts priced in for the remainder right now for the Fed for 2026. But those first cuts, I think, are just hitting. They work their way into the real economy. I look at things like lending standards and M2 growth, like credit growth in the system. It's not a perfect measure because not everything is captured in that. But in 2023, M2 year over year was minus 5%, and we're at 4.3%, which is a little bit below the long-term average looking back. So money is getting into the system, and I think it's partly influenced by those rate cuts that we saw at the end of 2024. In terms of the fiscal side and thinking about government stimulus, I see this as really three pillars. Whatever happens with tariffs in the Supreme Court,
Mhm.
taxes from the One Big Beautiful Bill, and again, One Big Beautiful Bill is CapEx depreciation and the incentive to invest in manufacturing, property, plant, and equipment, as well as full expensing of R&D. So when you add it all together, just to kind of go quickly, potentially, 1.6% of GDP, $490 billion. I keep looking every day for an update on the Supreme Court and, Trump's most recent post, I think, online. Social media is like, this would be a mess if this was had to be undone, if companies actually had to pay back some of what they've received, some of what they paid. But potentially, I mean, I do look at the average effective rate for tariffs. It's right in the 12 to 13% now. It's obviously a lot higher than it was pre-Trump 1.0. I think that could go down to 10%, and it could be a boost. I don't think there's going to be a complete reversal of what's been paid, but potentially lower tariffs could be a tailwind. On the taxes side, we're looking at potentially record high tax refunds for individuals. That's going to be good for the consumer, you know, purchases. We have seen more of the spending shifted towards services rather than goods, but honestly, to me, it doesn't matter where it's spent, as long as it's spent. They about 70% of tax refunds typically get spent. The other 30% goes into savings. On the CapEx depreciation, I don't know, bring it home, bring manufacturing back, build data centers, build more hyperscalers. I think this is a benefit to incent. I'm not a tax expert, but this is, I'd say, a strong incentive for investment in the United States. And the more R&D we can do, historically the U.S. was kind of light on industrial policy compared to think about like you know policies in China where the government was really driving and where the investment should happen. So on net, I think this is actually a good move for the U.S. In terms of economic policy uncertainty, if you look back to COVID, I mean, COVID was obviously crazy. We were all at home, unfortunate for the health impact, and thankfully we had helicopter money. But uncertainty was extremely high. Looking back to Liberation Day, we eclipsed that back in April of 2025, and it was like, I don't know, that didn't quite make sense. I mean, I know it was a pretty interesting day. We all saw what happened to the markets with that peak uncertainty. Markets don't like uncertainty, and this bounces around a lot. The latest reading here was up, but it's off, and I think peak uncertainty is behind us. Since Liberation Day, the S&P 500 is up 45%. So, market hates uncertainty, and I think peak uncertainty being behind us is a good thing. And we'll talk more about Trump policies here in a second. So, I do think it's a balancing act. When Trump got started, we thought we were going to get, the stuff on the right first, like tax cuts and one big beautiful bill, deregulation. We have gotten lower oil prices, which has been a boost, I think, for the consumer spending. But instead of getting that first, we got, concern over immigration, even deportations, and we got Liberation Day and tariffs and trade war. So it kind of ended up being the opposite sort of order. But now this has all happened. I think they're mostly offsetting each other. And again, I don't have a crystal ball as to what's coming from the administration or Supreme Court ruling, but we've really worked our way through these two things, and it is a balancing act. And what I would say to you and what I would suggest you say to your clients is that there's offsetting effects here. So not to be, thankfully we have the things on the right that helped balance what we saw on the trade side. And on the demographics, all things equal, I do believe that the more people you have in an economy, that can be a boost for growth. And if we do have a demographic headwind in the United States, so it'll be interesting to see how that plays out over. That's like a 10-year, a 10-year sort of trend. But we'll just have to keep monitoring that because it does impact real economic growth. So on the inflation side, this is U.S. core CPI, the Fed's preferred measure. And, assuming you don't want to eat or drive a car, this is what we should all be looking at. I mean, obviously all of us actually experience headline, right? We drive and eat food, but this is the more stable measure. We're down to 2.7 in headline and 2.6 in core. I don't think we're not at the target yet, but, I think we're headed still in that direction. It's been really interesting to see how shelter, like the cost that it is for the average consumer person in the United States to afford housing. So that's shelter, owner's equivalent rent. You put it all together, it's 44% of the U.S. core CPI basket. It's just such a massive piece. And the way that that component of CPI works is that it operates on a lag just based on the collection of the data. So from what I've seen, if you're looking at, home prices on Zillow that are, instantaneous, Zillow or Redfin, and the forecast that I've seen is that, there's definitely some challenges, I think, in housing, and the trend I think it has been lower and lower. Um, you know, the decline in housing cost has really helped us move from 6.6% down where we are today, and I believe that will continue. So inflation, I don't think is really in a problem for the Fed. What I think we should all be watching is the labor market. And so I'll touch on a few things. Unemployment, these are new unemployment claims. And back in COVID, we peaked around 6 million. So it's a it's a weekly series. It's timely. So I would say this is something to watch. We're nowhere near where we were. The most recent print, actually, if you were to look at if you could squint at the most recent month, and I don't want to read too much into one month, but was for lower. So, so far it's been pretty good on the employment side. I'll just mention the unemployment rate here. The unemployment rate overall has moved from 3.4%. It moved slowly, gradually higher. And I think some strategists out there say, look at this gradual move in the unemployment rate from 3.4 to 4.5. That's moved down to 4.3 recently. I mean, this is still full employment. So again, no crystal ball on where it's going, but I think we're at full employment. There have not been a lot of layoffs. I think the labor market overall is doing fine. Another reason that I think it's going to continue to do well is because small business hiring plans actually looks pretty attractive. Sorry to put two series. I'll explain this on the same chart. Um, the small business hiring plans, when it goes up, that means they want to hire more. The US unemployment rate, I inverted it. So when these two series look like they move together, it actually means that they're moving in the opposite direction. So what it means is small business hiring plans, if they are improving or increasing, that the unemployment rate, and there's other factors, would tend to fall. And so we're off the bottom in terms of small business hiring plans. We're not where we were, but I think we're off the bottom, and I think the move recently is a positive trend. 82% of jobs are in small companies, classifying that as companies with less than 500 employees. So I think we're looking pretty good. Looking at, and this is just my real economy dashboard. So on the left, I've got GDP growth, real wage growth, and retail sales. And the gray bars are the current. So the 2.3% growth there is for Q3. So that's right on the long-term average. Real wage growth at 0.8, right on the average. Retail sales a little bit below the average, but still positive. And we're nowhere near the 15 low. Obviously, we're not in a crisis. So, these measures seem to be doing, I would say, pretty well. So let's talk about Magnificent Seven, Carl, if it sounds like we should touch on that a little bit. Um, markets, at least US equities, I think we're just right around zero year to date. But a lot of concern just with the rally last year. We had 3 consecutive years of over 15% return in the S&P 500. And I've looked at the data going back as far as the IBITSINT data goes, which I think is like 1920s. You had 4 other instances of 3 years in a row where the S&P 500 was up 15% or more. And I don't want to read too much into just a few instances, and a sample size of 4 is not not predictive. But in 3 of those 4 cases, you had the fourth year come in at another 15%. So a 750% batting average. The most recent exception was 2022, was the year when you didn't get it. And you do hear from Warren Buffett, buy low, sell high. This is interesting. This is analysis looking at if you actually invested in the S&P 500 on the day that it reached the all-time high. As long as you invested for long enough, you actually did even just a little bit better in terms of an average cumulative 3 and 5 year return. So, you know, I'm not saying, I'm just saying the longer you invest, I don't think you need to be super fearful. The most important thing is, have your money in the markets, stay invested, don't touch it. So I just thought this was interesting analysis to share. In terms of market concentration, we've seen concentration cycles in the past. So any point on this chart moving from the bottom, like a low to a high, would be a concentration cycle, is how we're defining it. And we have a piece out that shows this, as well as other research related to whether large beats small or value beats growth, that sort of thing, in after the peak in concentration. I won't go into those numbers, but this is just super interesting to see. It's about 80% of the market value of the top 10% of companies is 80% of the market. It's really astonishing. This year, I think if I pull up Meg 7, we're obviously seeing some broadening out and some differentiation. Apple's off 10%. I think of the Meg 7, the only one that's positive now is Google for a year-to-date basis. A few weeks ago, we had 3 that were positive, and a few that were negative. So watching this every day, I do think it's a good opportunity to really think about what else you have in your portfolio that could provide some offset if there is an unwind. In mega cap tech, we're seeing we've seen a rotation for sure. Small cap is outperforming. I think that's partly due to people taking money out of US large cap growth. And for all the Magnificent Seven talk for 2025, value actually held in pretty well. Like the US value only underperformed US growth by, I think, something like 3.5%. So it still did lag, but it wasn't so disparate as it would have seemed if you just kind of read the newspaper. Okay, another area of the market that we really like is mid caps. We think that mid cap stocks um, benefit from deregulation. You think about a company that's relatively small and being successful, moves up to mid cap. They've got to invest, there's a lot of costs that come associated with becoming a larger company. 40%, 47% increase, you have red tape, you have audits. There's essentially more and more compliance. So to the extent that we've seen a deregulation, and that's going to be persistent, we believe, we think this is a tailwind for mid-cap stocks. The reason it declines for large cap companies is because large cap companies, this is on a per employee basis, and there's just large cap stocks have so many employees. So it's in fact on a per employee basis, mid cap stocks actually benefit the most from deregulation. In terms of the earnings picture for mid cap, so this is the Russell Mid Cap Index, and you can see how in 2024 and 2025, the earnings growth, we got to update this. That was an estimate for 2025, but lower earnings growth for mid cap stocks than large. That gap has really closed in terms of expectations. So now we just have to wait and see, if this comes to fruition. But just based on consensus, mid cap stocks have caught up, and now we just need to wait and see if it delivers throughout 2026.
And a couple of questions probably on the U.S. equity side.
Oh yeah, sure.
Yeah, I mean, you highlighted that, call it kind of past performance necessarily isn't indicative of where future performance is. Certainly, looking at a couple of big rising years ahead. I mean, the big question I constantly get is because it's spray painted all over television is just valuation. How do you guys kind of write that story into your equation when we just look at historical valuation? Because I think that's what a lot of people are just calling for, saying, hey, the valuation numbers have to come down. Do you guys see enough growth, call it in large companies this year, to offset and pull the valuations down to really keep the market where it's heading? Or or you just think valuations may just stay elevated for a long time?
Yeah, I guess I would say I have a mixed opinion. In the short term, the PEG ratios, so like PE over, instead of just forward earnings for 1 year, it's like a long-term 3 to 5 year growth estimate.
Mhm.
PEG ratios for mega cap tech aren't terrible. Um, so, it's true, like that analysts believe that those stocks have higher earnings growth potential, and they think it's true for 3 to 5 years, and potentially longer. So from that perspective, I don't have it up. I know that they don't look as expensive on a shorter term basis. However, I just want to show so that the long-term capital market process that I'm involved in, as I mentioned at the beginning, is a 10-year return
Mhm.
forecast. And here, in this model, um, we are thinking about starting valuation and how that impacts future return so that it's been
Yep.
studied. And it's astonishing. So right now, clients don't love seeing this. This will probably only show this to this community of advisors that are working with end clients. But it's true, we're concerned. US large cap stocks, the number we're putting out is 1.1%, and that's a nominal 10-year return. We do believe that it looks like there's a small cap premium over the 10-year horizon. So I guess to answer your question, I am definitely concerned, and I'll bring it into this. So, oops, sorry. So this is a basic analysis of only one of the equity building blocks. I mean, it's not just Ford P that matters. Um, Real sales growth matters, profit margin matters, dividends, and what the inflation rate ends up mattering. But PE does matter. And so it's a scatter plot here of what the PE was for the S&P 500 and then what was the 10-year return for the S&P 500. And we are over towards the right at about 22, this gray
Yep.
bar here. If you were to track the regression line, obviously there's a spread around the regression line, and the spread around the regression line is bigger the lower the PE. But up here, it's pretty tight. Um, and we don't have too much data up in this level, but this analysis would suggest if you just looked at PE alone, maybe a 1.5% return, which is just coincidentally very close to what we're publishing on the long-term side.
Mhm.
Taking the S&P 500, excluding the Magnificent Seven, this is like on a holdings-based analysis. You come out with a PE of about 19.7. Now, I don't have the historical 10-year returns for the S&P 500 excluding the Mag 7, but conceptually, I think this is interesting analysis. If you track that gray bar up from 20, I guess it'd be slightly higher, right about here. Maybe you're closer to 5% over a
Mhm.
10-year horizon. So I do think it matters. But I am a little bit in the camp of, yeah, you got to have some value in your portfolio. You should have some international. You should have some small or mid caps. But I will say for those um, that haven't looked at the PEG ratio, I think the PEG ratio kind of holds these stocks in a little bit more maybe than sort of the market being overly concerned about year-to-date return. We're only how many weeks in? Not that many weeks into the year. So valuation matters to answer your question for sure.
Yeah, I mean, so when you're doing portfolio allocation, then if you're projecting that kind of a 1% 10-year return, are you guys leaning a little bit more into the international space, or is it more so leaning into the small and mid companies to kind of offset those lower returns?
Yep, sounds good. Let me keep this over here. Yeah, so here we go. Sorry, I had it up. Wrong screen. So, we've been a fan with this model of non-US equities. So we've got international up at 7, emerging markets at 8. Uh, and that's a lot more than we're thinking you're going to get out of small cap at 3.1. So I'd say over long run, preferring international and emerging markets. I mean, it's just been incredible to see the value style do so well within EFA, especially on the financials and industrial side. Just with rate cuts from the ECB, they started cutting earlier, they cut more. German fiscal package, manufacturing heavy. China's been doing pretty well. China GDP just came out. They hit their 5% target. And if they say it's going to be 5% for 2025, darn right, they're going to print 5%. People that look under the hood of China think that there's long-term concerns around um, demographics and things like that, but 5% wasn't too far off from what sort of actual widget economic activity probably was. So to answer your question, I think leaning in, making sure you have at least some international equity in the portfolio. Okay. Carl, does that make sense? Where did you want to go from there? I got
Yeah,
a, I got
I
a, I
think
got
you
a
were
few
gonna.
more.
I was gonna say go ahead and go into your international, and then I can ask some
Okay,
questions.
perfect. So yeah, I'll skip this. This is just the long run rolling 1 year. This is 2025, just showing how international had such a great year. This is our compositional difference between stocks inside the United States versus outside. So 34% of the S&P 500 is tech versus only 14.7 for ACWI ex-US, so almost 20% more. So when you look outside the United States, what are you getting more of? You're getting more financials, industrials, and materials. You're also getting lower valuation, whether it's PE or price to book, lower concentration. So the top 10 stocks only comprise 12.8% of the index, and you are getting a higher dividend yield. I think people know this. It's just nice to put it right in front of people. And I guess just to loop it all together, so our long-term thinking that I showed, the forecast for US equities down at 1.1%, ties right into the historical data. Um, so again, kind of long-term analysis, but if you looked at US versus international over all periods that are available going back to 1970, the US outperformed in more than half, 55%. International outperformed by 45%. However, when US equity returns were less than 6% over the 10-year period, international outperformed in 100% of the period. So this history does align with our forecast. History doesn't always come true, but it is interesting to think if models are suggesting lower return for US equities, it's just astonishing. Even historically, 100% of those periods, international has outperformed. So this is a case where history really, I mean, 100%, like history really backs this up. I'll just skip through this. This is PEs. I guess I'll just say EAFE evaluations are above the long-term average, 15 versus 14. Um, so it's not like they're undervalued versus history. They're just not as overvalued as US stocks. Here's the earnings growth catch up. So for 2026, earnings growth forecasted for MSCI Europe to be 11%, and that was trending at the bottom, or basically no earnings growth, which is really astonishing. So that catch up, I think, drove the outperformance that we saw last year. And again, for that to hold, we need to see 11% come through in the numbers. So,
What would you attribute that most to?
the improvement,
Yeah.
yeah. Hang on, let me see. Got okay. This is on my other page, and it's for U.S. stocks, but I would have to pull up an Excel. But you will find this constructive around earnings. Um,
Was there any particular leaders just was it you just had a lot of the banking companies doing really well,
Yeah,
or,
I mean,
yeah.
oh, absolutely. I mean, um, yeah, financials outside the United States improved dramatically. So in the US, we saw growth beat value by a little bit last year,
Mhm.
and we saw the exact opposite, and the difference was just astonishing. So EFA value beat EFA growth by, gosh, the number's not in my head, but it was a lot. I think it was more than 10%. And so that was, I think, the primary driver of European outperformance. When I think about just generally stock earnings across sectors, we have this piece called our market monitor. We put it out monthly,
Mhm.
and you know, I'm looking at this by sectors just to see what happens. The two of the sectors I mentioned were energy and materials, and you can see for materials, -10, 3.1, looking at 21 for U.S. material stocks. Uh, energy had a tough 2025, and it's forecasted to be 7%. So there's been some change there. European financials did really, really well. The earnings expectations for European financials a little bit is different than what we're seeing here for US stocks. This shows a decline, but you saw a pretty massive improvement in financials earnings outside the United States. So we do track this. I should build a European version of that. But yeah, to answer your story, it's financials.
I think it's helpful for folks though to just to realize that by having the international exposure within your portfolio, you're leaning a little bit more into value, which happens to help to offset a lot of the growth concentration that you're seeing in the US. So it becomes a natural diversifier for portfolios, which is, obviously a big reason why we're in favor of it in general.
Yeah. And then I would say have a slice of emerging markets as well. You know, I would say there's things like that people don't realize, and I'm not an expert here on EM, but India GDP is forecasted to be 8%, real GDP growth. So there are certainly good stories, for sure. Another thing that we're watching is just the fiscal announcements coming out of Japan, and there's, politicians making promises again about your reductions in the sales tax, for example. So that could be another boost for, not everything politicians promise, comes true, obviously, but you could see, fiscal boosts. We saw it out of Germany. Maybe now we'll see it out of Japan, right? Um, a little bit of concern long term about Japan's debt sustainability, but I mean, at least for my take, like fiscal stimulus from politicians tends to hit real GDP, in the now. So, or at least the expectations of it. So, yeah, there's definitely some good stories to look for outside the United States.
Do any of these geopolitical issues scare you? When we start talking, because I mean, that's one of the bigger questions I'm getting now is,
Yeah.
how, as a portfolio manager, on the day-to-day basis with all the headlines, how do you guys think about shifting the portfolios or is it more after you see something really come to fruition? Obviously, the Greenland's a hot topic, but how are you guys thinking about that in relation to kind of your international exposure and US exposure?
In terms of US, non-US allocation.
Yeah,
Yeah,
because in
I think,
general,
yeah,
right, you're hearing
right.
like you have some country, obviously the pension fund dumping US, more volatility. How are you guys thinking about some of those kind of geopolitical issues with regards to your portfolios?
Yeah. Yeah, so I mean, Venezuela, for example, I think that was really caught everyone's attention. I mean, that was like a national story. I think that's slow, very slow to play out in terms of impact on actual oil supply. There's a lot of investment needed to fix the infrastructure. So I don't think there's any immediate uptick there. I do think Trump has definitely, he doesn't like Europe, and I don't think European leaders really like Trump very much. So I think, you have seen um, leaders in Europe kind of like, okay, what are we gonna do here? Um, I think it's really about Trump wants those rare earth materials that are up there. I don't know that I believe it's as much for national security as it is like the natural resources. Um, I don't know. I haven't really thought about other than a headline risk, Greenland having a lot of impact on portfolios. I mean, it adds some uncertainty to the markets, but I don't think Greenland is a large share of any there's not a lot of economic activity or companies based there. So I think that's a non-event. Yeah, those were my take on those two.
What about, I guess, the concern of you guys thought about, or if things kind of heat up between US and Europe? I mean, or is that still, again, you're not really too concerned about kind of NATO related issues and World War III, which is, some, people throwing out there. But yeah, or is it still too early to really worry, fundamentally in shifting kind of your allocations and models, et cetera?
Yeah, it's not impacting model or asset allocation that we're really recommending. I have not personally heard a lot of positioning changes when I attend, our macro meetings, or any of the sector team meetings that I join. within MFS. So people are talking about it. I have not heard. I mean, I guess one thing that I have heard a few times over the last year, it's not to do with it's not like Iran or Russia, Ukraine, but just in terms of on the consumer cyclical side, so thinking about brand value, one thing that has consistently been a topic is which brands could suffer from any anti-American sentiment if that increases. So it is something to think about. I mean, companies like Nike, they do sell a lot of stuff. I mean, these global multinationals. And so unfortunately, I don't think there's really a data series that you can track that. You can't punch that into Bloomberg. Um, but that is something that's being discussed on on the individual security level is, which companies have the greatest risk. Um, where do their sales come from, right? A lot of them into China, things like that. Um, so, again, haven't seen it impact asset allocation, doesn't impact any of our modeling work, but something at the micro level that is being discussed.
I have one question. Regulatory costs are only falling in favored industries, while oil and automotive companies might be seeing less regulation. Um, well, in fact, are finally seeing, I think,
Yeah,
that's
I
one
think
point.
I think that's a big reason why we see the forecasts for earnings growth for energy, looking actually improving despite the fact that we've seen low oil prices. So like last year for WTI and Brent, so WTI was they both declined on average about 20% last year, and yet still, I do think that Trump policy related to energy is the main driver why you've seen an increase in the 2026 estimated earnings for S&P 500 energy. So I just felt like that's where you were going, and that's a
More
sector that
regulation specific. So probably a little bit more nuanced for the conversation.
okay.
Um, any other things that listeners should be mindful of? I mean, I know again it seems like the takeaway, and you can kind of get in fixed income for that, but on the equity side, I guess the takeaway is valuations are high. You guys are projecting some lower long-term returns, but the opportunity set probably is going to be more um, outside of Mag 7, right? And then there seems to be a much better opportunity in the international markets. Would that be a good summation from you
Uh,
guys?
Absolutely. Yeah, and I guess I don't think you need to make, if you're particularly overweight and if you're looking at portfolios, and I have seen it in some of our model review work, it's astonishing. We typically start with allocations close to the global equity market, right? Like, so how much is in the US, international, and EM? We think about that as like the market portfolio. But when I've done these model review projects, I've seen equity allocations be 90% US, even 100% US. And so that still doesn't make sense to me. I think for that type of portfolio, that's where you could, you know, I think I would recommend or think about making a strong increase to international, but it depends what you're seeing. If there's a client that has, 30% in international, then probably they don't have to make as I wouldn't recommend as big of a change. So I think it really depends on your starting point. But the overarching view that you expressed, I think is true here within MFS.
Perfect.
Yeah.
And then I think you're maybe going to touch a little bit on fixed income there. Then
I
we
mean,
can. Oh,
just briefly, not going to go too deep on it. And we have other, I guess, exhibits, but yields have risen material. This is a source of potential return. It's really interesting to think about what yield means. I have a fixed income 101 presentation where I really dive into all the assumptions of the yield measure. No new bonds come into the index, none exit. There's no defaults. All bonds are held to maturity. So it's a very onerous assumption associated with the calculation of yield or yield to worse. But yield has returned to fixed income. Credit spreads are pretty tight. So I think, with the Fed only expecting, market expecting two two cuts um, throughout this year, that that could be a slight tailwind, but yeah, just go to clipping coupons. I think is where the return would be most likely to come from. We all know why you hold fixed income a portfolio. It's the ballast against those really bad years for the S&P 500. I wish I had it up. We have calculated, what was the average return in the worst 10 years for the S&P 500. So if the worst year for the S&P 500 averaged something like, I don't know, 27% decline, fixed income was on average positive. And in the 10 best calendar years for the S&P 500, fixed income was also just very slightly positive. But we know that the main reason you hold it is when equities are going to struggle. So, overall, we still like fixed income. It's got to be in there in the portfolio. So that's just sort of the overarching view.
Do you guys have any opinion? I mean, it's obviously gold, silver metals have just become a pretty hot topic. Do you guys have any opinions on your feeling it within portfolios and just, I mean, are they still going to be a good diversifier with the run that they've seen? Because it's been pretty incredible how much they've come up and and they keep going up.
They do. So gold was up 67% last year. We designed an asset allocation game that we're using for big MFS hosted conferences. And, basically the people in the audience build a portfolio and pick their weights and they put in a little scaler for forecasting returns. And we decided to include gold. We built this game over the last year. And when we started out thinking about what are the 10 asset classes you'd include for an average US, investor, our first thought was, broad-based commodities, it would be enough. And if you look at certain multi-asset portfolios managed within the building, there is an allocation to broad-based commodities. And so broad-based commodities have been a great diversifier. Gold has also been a diversifier. The volatility of gold alone is higher than broad-based commodities, but the return has more than compensated for the volatility historically. And if we went back to 2000 and gold has delivered, I don't have the number in front of me, but I think it's close to like 8 to 10% annualized return
Yeah.
since 2000, and that's a 26-year period. So I don't know. It was hard for me at first to get my mind around these level of returns when I think back to stocks, at books like Stocks for the Long Run, which basically said the only way to get real return over a long period of time was hold stocks, to beat inflation, and bonds will get you some over inflation, but cash alone is not going to be it. I'm leaning more towards gold so far. We're if there's instability, economic uncertainty, it seems like we live in a more uncertain world than ever. I can't argue against someone that wants to hold some gold. I used to say, if you want it to be 5% of your portfolio, that's fine. We allowed, I think, up to 10% in our game. So we didn't allow people to put more than 10% gold. But I don't know. I guess I'm still it's hard to forecast what's going to happen with uncertainty and the dollar and things like that. But I guess I will just mention, sorry, the foreign central banks selling US treasuries and buying gold has been, I think, a big driver. And I've seen charts on that. I can't think of any dollar, the whole dollar debasement story. That's really it. And I think I can't think of any reason why that would just be such a short-term phenomenon. So I think more buying by foreign central banks is still a tailwind for gold.
Mhm.
So
Any other final points as we finish up here for today?
let's stop sharing here. Back to the group. Yeah, please.
Um, yeah, so I think as we finish up for the folks, I think it's helpful just getting a better understanding of just where we're seeing the models in the market going, each of these subsets. MFS is certainly a leader in the space, both globally and domestically. So for any of the guys on the call, if you guys have any questions, feel free to reach out to me. I can certainly lean on Bryan and his team. Again, I think the big takeaways here. I've seen this many times in portfolios where people have just been very underallocated to U.S. markets. So international certainly is a space you guys should consider. Again, I can give a plug for MFS. They are certainly a leader in that space as a manager, so certainly take a look at them. But as always, feel free to lean on me as a resource. Bryan, thank you for the time today, and I look forward to catching up with everyone soon.
Great. Thanks. I appreciate the opportunity to join. Thanks, everyone.
Thanks, guys. Take care.